All right, let's talk about a totally different way to look at the market. Forget just spotting patterns for a second. We're going to dive into a framework that helps you understand why prices actually move. We're talking about the real engine behind it all, that constant battle between buyers and sellers. Okay, so to kick things off, let's start with this kind of a wild idea from the source material. It says, we study chart patterns so that we do not use them. I mean, think about that for a second. It basically flips everything you've probably learned on its head, right? It's suggesting that those very patterns you were taught to hunt for, they might actually be traps. So, if the classic patterns are just a big trap, then what are you supposed to look at instead? That's the big question, and that's exactly what we're going to unpack today. We're going to move away from a method that's, let's be honest, often really frustrating, and into a much more logical way of thinking that actually explains the why behind the price moves you see on the chart. First up, let's get into the weeds on this, the chart pattern trap. Why is it that just relying on these familiar shapes so often leads to, just complete frustration and failure?
Well, here's the thing. This framework argues that most patterns fail because they have zero context. They don't tell you why the price is moving, they're just an effect, not a cause. A head and shoulders pattern can pop up anywhere, but it only really means something in a very specific location. So the source material suggests they're actually taught so you know what the common traps look like, so you can avoid them. It's kind of like trying to navigate a city using a map that has no street names. Sure, you see the shapes of the blocks, but you have no idea where you actually are. That's why they feel like a trap.
Okay, so if we're throwing out blind pattern following, what do we replace it with? This is where we get to the core idea, understanding the market as a battlefield. And on this battlefield, it's all about zones versus simple static lines. And this comparison really nails the shift in thinking. On one hand, you have traditional support and resistance, which is just a static line on the chart, right? Like yesterday's high, it's a single price. But on the other hand, we have demand and supply. This isn't a line, it's a dynamic area or a zone. It's where real buying and selling pressure built up. It's the area where negotiation actually happened.
So, what is a demand or supply zone? Think of it as an area on the chart that holds a kind of memory. It's where buyers and sellers have really duked it out before, creating this leftover pressure. It is never a single price. It's just like negotiating for a house. The deal almost never happens at the exact asking price, does it? Nope. It happens within a certain range, a little zone of agreement. The market is exactly the same, creating these zones of intense negotiation.
So what's actually making the price move between these zones? You might think it's some complex algorithm or a fancy indicator, but at its very core, it's much simpler than that. It all comes down to human psychology. It's about compromise.
And there's this fantastic analogy to explain it, the potato vendor. Picture this. A vendor wants to sell his potatoes for 50 rupees, but the buyer will only pay 40. They're at a standstill, no deal. But then a wedding planner comes rushing in. She's desperate. She needs potatoes for French fries, like right now. She doesn't have time to haggle. To get the deal done, she just offers 60 rupees, a premium over the asking price. Bam! What just happened? The entire market shifted. The vendor now knows he can get 60, so he's not going back to 50. A whole new price level was just established because of that one urgent buyer. That urgency, that's what creates true demand.
And that really boils down to the only two things that truly drive price movement. First, you have true demand. That's when buyers are forced to compromise and pay a premium. They pay above the current price. And then you have true supply. That's when sellers are forced to compromise and sell for less. They have to sell below the current market price. That's it. It's not news, it's not volume by itself. It's one side giving in out of weakness or urgency. And that's what shifts the entire landscape. Okay, so how does all this psychology in these zones build into a complete, usable system? Let's look at how we can actually read any market condition just by watching how these buyers and sellers are interacting through what are called the 9 market structures. This is where it all comes together in a really elegant way. If you think about it, demand, what buyers are doing, can only be in one of 3 states. It can be rising, dropping, or just constant. Same thing for supply. Well, when you combine those 3 states for demand with the 3 states for supply, what do you get? Exactly 9 unique market structures. That's it. For example, check out the table. When you have rising demand, meaning buyers are willing to pay more, and you also have dropping supply, meaning sellers are backing off, what do you get? A strong uptrend. It makes perfect sense, right? These aren't just random patterns anymore. They are the logical results of the ongoing battle between buyers and sellers. And the underlying logic here is actually super simple. Think about it. Demand dictates the swing lows. If demand is rising, buyers are stepping in at higher and higher prices. What does that create on the chart? Higher lows. And on the flip side, supply dictates the swing highs. If supply is rising, sellers are getting more and more aggressive at lower and lower prices, creating lower highs. This simple logic applies to every single one of those 9 combinations. All right, this next part is maybe the most important piece of the whole puzzle. It's what the source material calls the golden rule, the one non-negotiable part of this entire framework. If you only remember one thing from all this, make it this.
And it's this: location is greater than the pattern. Always. Let me say that again. Where a pattern appears on the chart is infinitely more important than what the pattern itself looks like. A picture-perfect textbook pattern in the wrong spot is completely, utterly meaningless.
So what does that mean in practice? It's the key that connects everything we've talked about. A bullish pattern, like a double bottom or whatever, is only valid if it shows up at a major demand zone, a place where we already know buyers have shown up in force before. And a bearish pattern? It only matters if it forms at a supply zone. Any pattern you see floating around in the middle of a range between these major zones, that's just noise. It's a trap, and it should be completely ignored. Okay, but to actually apply this, you need to be able to draw these zones correctly. And the framework is really specific about this. There are strict mechanical rules. First, a zone needs to have at least 2 or 3 touch points to be valid. Second, you draw the zone connecting the absolute highest wick to the absolute lowest wick across those points. And here's the crucial part. The zone must never intersect the bodies of the candles. The bodies represent where price closed, the market consensus. The wicks are the battleground. So you're using a tool like a rotated rectangle on your platform to box in that battleground.
So let's wrap this all up. We've seen how chart patterns without context are just traps. We've talked about swapping out those simple, static lines for dynamic zones of demand and supply. And most importantly, we've learned the golden rule. Location is absolutely everything. A pattern means nothing unless it appears at a valid zone. The whole goal of this framework is to shift your entire perspective. It's about stopping the hunt for passive shapes on a chart and starting to actively read the strategic battlefield. You're learning to see where the buyers are digging in to defend their territory and where sellers are making their big stand. So I'll leave you with this question to think about. When you look at a chart now, are you just seeing patterns, or are you seeing the battlefield?